You shouldn't take statistical analysis or probabilities that seriously when it comes to your retirement plan. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. I'm sure you're excited to hear about this, but I'm telling you it's important because all retirement plans are based on statistical probability with confidence ratios, bell curves, standard deviations, and I'm going to share with you right now, while it is okay to understand that, you just got to take it with a grain of salt. So welcome to Heritage Wealth Planning, the place you come to learn all about financial, retirement planning, taxes, you name it. So don't forget to subscribe, my friends. All right, so let's dive right into this. This is pretty interesting. So I was looking at some numbers, and I have a, if you're familiar with Nassim Taleb, Nicholas, and stuff, we got lots of, and I'm not going to read this to you, but I keep an article that he had written. No, it wasn't him. Is a non-technical introduction, Benoit Mandelbrot's multifractal view of financial markets versus modern financial models. It's from the American Academy of Financial Management in spring of 2000. Anyway, I keep it because it has a nice list of all the various statistical probabilities of real-world events and why they should never have happened, but yet they have happened. And yet people say, that should never have happened, but it did. And it happened over and over and over again. And so after the market, we had a 5% decline in 2 days. I said, that's pretty phenomenal. That's pretty, that doesn't happen much. What's the likelihood of that happening, given a bell curve? So a bell curve, let me bust out my little thing here, and I'll show it to you. But a bell curve, let me actually make myself a little bit bigger. So a bell curve is simple, like this. All right, it's literally the simplest thing. So what happens here is you have your median, all right, and that's 50% of the time is on one side and 50% of the time is the other. So that's what's called the median. So if you have your median rate of return, will just say 8%. All right, so that's 50% of the time you get an 8% rate of return, 50% of the time you get, or a higher than 8, 50% of the time you get a lower than 8. Then you say you have your first standard deviation, which would be 4 to 12. All right, so 67% of the time, the markets fall within 4% or 12%. That's the first standard deviation. So your median is 8%. Your first standard deviation is between 4 and 12%. So 67% of the time, the markets fall there. Then you have your second standard deviation. What would that be? 0 and 16. And that's 95% of the time. This will get kind of confusing here. But basically between 0 and 16, 95% of the time, the markets will fall between there. And then you have your third standard deviation, which is 20 and minus 4. And I'm just pulling it. I don't know if this is right or not. I'm just using this for an example. And it says at the end of the day, between 99.6% of the time, you'll get a -4 or a 20% rate of return or something like that. Just for simplicity, that's how a standard deviation works on a bell curve, right? So that's how that works right there. So what happens is, though, in the real market, you have these things called fat tails, which means that you have all these things happening on the end of it, which really aren't likely to happen. So these are the fat tails. So you have these huge negative, for instances, that really should never happen. So you have this thing going up when it should be just basically 0. I mean, it basically should be going down. And that is the risks that's inherent in market investing or any kind of risk out there, the fat tail risk. The standard deviations, the statistical probabilities are these things won't happen, yet there are fat tail occurrences that happens all the time that a standard deviation, a simple bell curve model won't show. All right, so anyway, so I'm looking at this, I'm saying, what was the standard deviation relative or the likelihood on a bell curve for 2 days, the market falling by 5%? And I didn't take too much because I came up with this article that I want to share with you, which I thought was very, very interesting. So this guy, Vance Haywood from Six Figure Investing, Harwood, he says, consecutive up days on the stock market and the gambler's fallacy. Years ago, I was watching the action around an Atlantic City roulette table when I noticed a man taking careful notes. When I asked what he was doing, he said he was looking for long consecutive strings of red or black. If the run got long enough, he was going to bet that the ball on the next spin would land on the opposite color because it was due. When I asked him how the ball knew what colors it had previously landed on, he frowned and shifted a few steps away. The gambler's fallacy is an intuitive belief that long streaks, even with fair coins or dice, influence the odd of the next result. And basically what we know is when you flip a coin 10 straight times, the 11th flip still has a 50% chance of being heads or tails, regardless of what the 10 previous flips did, because there's every individual flip is a 50% chance, because the previous flip, this flip has no relation whatsoever to the previous one. So it's completely 50% every single time, regardless of what the last 10 flips did. On a day-to-day basis, the stock market is a lot like the game of roulette, with a probability of an up and down day being very close to 50%. However, unlike the roulette ball, the people and computers trading on the stock market can remember what has happened precisely. So after a long stretch of up days, you would expect a higher probability of a down day, or so I thought. For a long time, I've believed that the market tends to move in 3-day cycles, but inspired by reading Moneyball, I decided to see if the data supported my intuition. I took the S&P 500 index from 1993 to 2013 and analyzed market moves after 3, 4, 5, and 6 days in a row. Rather than just plotting binary up or down results, I plotted the frequency of the percentage results using 0.1% bins. So next day, S&P returns after 3 up days for the 10 years. And if you see that red line, that is your standard, that's your typical bell curve. And as you see down here, it basically gets to 0. But now, and I'm not sure exactly what the standard deviations are here in terms of the I don't know. But here we got, this is not supposed to happen, because here's the bell curve. That's not supposed to happen, yet it did. This isn't supposed to happen, yet it did. And now, again, the bell curve shows you that, I mean, look at that. We have a huge, that's way above what we would think would happen. Now, I mean, there is some probability that there is some, I mean, legitimacy to the bell curve for sure, and the standard deviation model. No one's going to sit there and say there's never an instance where the standard deviation model cannot be defeated. But, you know, that's pretty interesting, right? I mean, these things really, look at that. You do have some stuff outside the typical bell curve, which really isn't supposed to happen, or at least not very much, that's for sure. And yet it happens quite a bit. The red line shows the outline of what a perfect normal distribution would look like. The actual data is more clustered around 0, which is right here, right in here, underrepresented on the side of the distribution with some rather extreme events in the tails of the distribution. Exactly, rather extreme, and that's called fat tails. Instead of supporting my intuition, the data shows that the market is very much like roulette, with no directional bias at all after 3 consecutive days. In fact, the average return is a plus 0.016%, indicating very close to even odds. However, it still always defaults, I should say always, still defaults to the positive side. Isn't that interesting? And so here we go after 4 days, and look at this. Now we got some serious fat tail events here, way out here. And we got, you know, we're busting the standard, the bell curve. We got, that's not fat tail as much, but look at these fat tail events way out in the always on the negative side. Isn't that interesting? That the big fat tail events are on the negative side, the downside. Next day, S&P returns after 5 days. Look at these guys way up. It looks like that tower in the Lord of the Rings. Remember when Sauron was on that one tower? I forgot what it was called. That huge tower that went way up high. That's what that looks like right there to me. And again, huge fat tail. Look at that. That's way out there. That is not supposed to happen for sure. The sequence also show average returns close to 0, with even odds of the number of consecutive days with gains should decrease by 50% with each additional day. For example, 6-day bull runs should happen as often as 5-day runs, and that is how the market behaves. The chart below summarizes the statistical results. The 5 up-day statistics are distorted by this huge 8.9% drop on December 1st of 2008, which literally should never have happened. So I include the 5 up days without that drop. And basically what he's saying here is we can see average day returns. I mean, basically after 3 up days, average days after 4 up days. I mean, you can just kind of go through this, which I won't. But anyway, it's interesting. If you exclude the 7 sigma event, look, I mean, that's that 7 sigma event. I mean, that really should never happen. I don't know what the statistical probability is, but once in a trillion years or something like that. In 2008, there was a trend towards less actual volatility with the next day with longer bull streaks. It might be the case that the people involved in the market become increasingly aware of the bull run and start behaving cautiously. This trend would be of no help for directional plays. So in terms of market timing, you're going to base on the previous day. There's no basic. It's basically even odds. You might get up, you might get down. We just don't know. And it's hard for me to imagine a volatility play that could take advantage of a one-day lull. Clearly, my notion that the market moves in any 3-day cycles was bogus, and the data suggests that any sort of directional analysis based on market history is just another example of the gambler's fallacy. So again, if you think there's momentum and you think or the market's up for 3 straight days, thus it should have a down day because it's due, there's just no history of that, at least in this guy's study. He ran 10 years and he plotted all the numbers. And he says, look, at the end of the day, it's basically even number, just like flipping a coin. You flip a coin, 10 to 100. If you had 100 straight heads, the likelihood of you flipping another head is exactly 50%, regardless of what the previous 100 events does. And that's what this guy says, with a little bit of default to the positive, but not much. It's basically even odds. And I thought that was pretty interesting. So I want to share that with you. And I didn't read the comments. You can read the comments here because I just thought mostly I want to show you what the bell curve looks like. That's a nice look at bell curve right there in terms of how it works and why you need to be concerned about these these huge freak shows out here, which it is a freak show without question, just not supposed to happen, but it did. And based on statistical analysis, the statistical probability, the likelihood of these events happen are so small that they should never happen in your lifetime, but yet we all live through it and it happened. So be careful when you use statistical probabilities to give your financial planning any basis in reality as if it's set in stone. The facts are Russia and China all went zero in the stock market. So even because of communists. So even if you have a 99% probability of success, the facts are, we just don't know what the next 50 years will happen. We just don't know. So that is another reason why you can control something as to pay off debt, as opposed to hoping and wishing that the market cooperates. We just don't know. If we did statistical probabilities and we factor in things unforeseen or things that could happen throughout the world of communists taking over, of a nuclear war, of all these things, that won't be factored in a typical bell curve for the United States, because a typical bell curve uses the previous basically 100 years of information that we have for the United States. That's it. And yet, in Russia in 1916, no one knew that the Bolsheviks were going to take over and nationalize everything and, essentially shoot their opposition. And so if they just used a previous 100 years record for that, they would have been completely ignorant about the Bolsheviks taking over. Same with Mao in China. No one had any idea. Now, I'm not saying the communists are taking over the United States. What I am saying is in 2018, we simply are only using the previous information that we have. We have no clue what the future information holds. And yet these statistical probabilities are just based on the previous information. So keep that in the back of your mind. All right, my friends, as always, if you like what you see, subscribe down below. Let me hear comments, questions, concerns. Go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks now.